Okay, hey everyone, this is Dara Albright coming to you live from the Crowd Invest Summit. We're having an exciting day here, and I am standing here with Bill Rouhana, who is the CEO of Chicken Soup for the Soul Entertainment. For those of you who don't know, the company just went public last month via Reg A+. They are the the world's largest Reg A Plus IPO. They raised $30 million, $120 million pre-money valuation. Great success story. They were able to attract very accomplished small cap investment bankers in the space. I've been following the story from the beginning. I truly believe that this really could represent the rebirth of the modern small cap IPO, or the rebirth of the IPO of yesteryear. The companies that went public and created tremendous amounts of wealth and innovation and jobs, and it's a really exciting time for our industry. So first I want to congratulate you.
Thank you.
And I thought it might be a good idea to talk a little bit about the process. A couple of things that you've done, which I think are really exciting, were your ability to really marry the crowd with the institutional market. And I could talk about a little bit about the process, why you chose Reg A+, and and kind of a little bit of tell everybody what your impression was. What would you do differently if you had to do it all over again?
Well, first of all, thank you. And we did marry the crowd and Wall Street together. We did that very consciously. And the way we did that was by not only having an ability to reach out to our fans, who we have 2.8 million Facebook fans, for example, who we reached out to, but we also put together a selling group, which was more in the nature of a traditional Wall Street selling group with lead underwriters and selling group members. And we did that combination because we thought that was the best of both worlds. On the one hand, we had the ability for individual investors to be guaranteed they'd get a piece of the deal, because if they came through the crowdfunding side, they were guaranteed to be treated fairly, which is not always the case in Wall Street deals. And then on the other side, on the Wall Street side, we were able to put together a group which at least had a reason to be involved after the IPO, which is very important because you do need a trading market.
I understand that, talking about the selling group, that you were really able to attract a lot of sell-side firms into the selling group and really kind of recreate some of those old syndicates that we used to have. That's also pretty unprecedented in this space. We haven't seen that before either.
Well, we had about 15 selling group members plus the 3 underwriters. So you're right, it was a very old style, we might call it, selling group, and a good one. I think what attracted the selling group members was the idea that there would also be crowdsourced investment that would come on the other side of the deal. And I think everyone thinks that combination ultimately is a very, very good idea for companies that have real passionate fans like we do. The implementation of that was not perfect, however.
Right. Okay, so that we could always work on. We should also talk a little bit about the company itself. I mean, most people know the brand, have heard of Chicken Soup for the Soul. It's a loved brand that's been out there across the world for a couple of decades now. But talk a little bit of what really Chicken Soup for the Soul Entertainment is, and what you're doing that I think is really so transformative in the media space.
Well, we are taking a different approach to the creation of content than most people. Our content, of course, is Chicken Soup consistent, Chicken Soup for the Soul consistent. It's about positive stories, about bringing the best out of the human spirit. It's all the things you would expect us to do as Chicken Soup for the Soul. The way we actually finance and create that content is a little bit different, because we work very closely with sponsors, foundations, nonprofits, as well as for-profit companies, and we create shows in collaboration with them so that we know before we start the creation of a TV series that it's already going to make money. So it's a very unusual model. We're not big risk takers when it comes to the creation of content. That's one side of our business. The other side of our business is building a direct-to-consumer online video business, and so for that, you should think Netflix, but for Chicken Soup for the Soul type content. And over time, we plan to offer that content directly to consumers using the internet.
I love it. I love it. So I'll talk a little bit about also, and I want to get into some of the fundamentals. in a second, because ultimately I believe that fundamentals will prevail in this industry, and that companies grow based on that they're doing they're doing great work, they're generating revenues, they're profitable. You are a profitable company already. And then I want to talk a little bit about what's happening just on the technical side in the markets. But first, I guess, talk a little bit about where you see, where you see you're going to end the year, and just on the fundamental side.
Okay, so the company started in 2015. We had one series on air. 2016, we had two. This year, we'll have several more. We started at a very, $1.5 million revenue, jumped to 8.1 million. We're on track for 20 million this year, in the mid-30s next year. We went from no EBITDA to around 4 million in 16. We should be close to 10 this year. In 18, I would, probably another 50% increase in EBITDA. So we've got a nice growth company, highly profitable company, good cash flowing company as well, a very important factor. So good long-term trajectory, and doing very well.
And I saw that a research report was just published that put a price target of $14 a share on it. So it looks like the fundamentals are good, and there's some exciting things to come. But we are starting to see, or have been seeing, some abusive shorting going on, and some manipulators in the market. And talk a little bit about that, because I think, especially for our listeners and our audience, we're all passionate about this industry of crowd finance and the small companies in general, and to see some of the hedge funds out there really trying to manipulate situations with fake news reports and abusive shorting. I mean, I personally find it offensive and problematic.
Well, it makes being public a lot less fun, too, if you're the CEO of a company and people are selling your stock for no reason, no fundamental reason. What we noticed, really the first day we were public, was that there was a very high level of high-frequency trading, and NASDAQ does not have an uptick rule on short selling the first day you go public, because there is no prior day close, and its rule is based on a 10% below the prior day close. So that was one sort of interesting problem. The other problem with the way the Reg A plus deals are structured right now, in my opinion, is that there's no over-allotment option. They call it a green shoe, which is where the investment banks sell more shares than they actually buy from the company, and therefore have the ability to stabilize the stock price in the open market. That's kind of important the first couple of days a company is public, because you need to get your kind of sea legs under you. You need to get the message out beyond the group of people who are in the investment already, and that this gives you some time and some support. There is no way to do that yet in the Regulation A plus structure, so I think that would be a very big help. So it's a combination of things, Dara, I think, that lead to a sort of uncertain start. And if those aren't dealt with, I think it'll be much harder for people to use this approach going forward.
So you've heard it, folks. So what we really need to do is we really need to have a legislative fix, or something we need to have really done on changing the rules around for borrowing shares on the first day, or on the trading side. But I also think that the other thing is to really we need to get out there with people understanding really what is happening, and these assaults that we're seeing on our small cap IPO market. Because if we don't see the small cap IPO, the rebirth of the small cap IPO, I mean, you're talking about companies that have created trillions of dollars in wealth, have created tremendous amount of innovation for the planet, have created hundreds of thousands of jobs for the American people. And if we don't really do something now, this is our one chance to bring that back. We need to get that back. I mean, this is I think this goes beyond even one company. I mean, we really need to do something. I think so. Everyone really that's watching this now needs to really do something from whatever they could do. Call their congressman, get out from maybe we make some noise legislatively, but also go out. Let's not take the abuse from the hedge funds. Let's everyone go out. And you could start by all going out. Hey, everyone go out and buy a share of Chicken Soup for the Soul Entertainment. How about that?
Well, that's a great idea. But let me tell you a couple of good things about Regulation A+, because I do think we shouldn't just look at the negative here. One of the most important things for us was our ability to talk to the press during the offering period. And as you know, in the regular IPO, you cannot do that. You have a quiet period. If you're a huge company, you don't need to talk to the press. They write about you anyway. But if you're a small company, in order to be noticed, you need to be able to reach out and proactively talk to the press and market your offering. This rule allows you to do that, and it makes a very big difference. It makes it much more likely you'll be successful in raising your capital. And I think that's probably the single most important thing that is in Regulation A+. There are a few things, as we say, that need to be fixed, I think, on the back end. Not sure anybody really anticipated exactly how these would trade and just what it would mean to send a smaller company out into the world without the kind of support that they have in other types of structures. I think that's the thing that needs to be looked at. So
right, and I've been saying that for a long time. Where when they came out with the Jobs Act, the goal was we need to fix the IPO on-ramp. We need to, it was really the on-ramp to the highway, but really I think that the highway needs to be fixed as well. I think we need a lot of repairs there. But this was so great. It's so great to see. I'm so excited for our panel, and really, this is congratulations again. This is an exciting time, I think, for your company, but also for the small cap IPO in general. So thank you.
Thank you.